Hello and welcome everyone to another episode of our market commentary from StashAway. With us again, our Chief Investment Officer, Freddy Lim.
Hi there.
First of all, before we get started, I wanted to thank everyone for being very interactive with us now on these videos. We getting a lot of questions, right?
Yeah.
A lot of good ones as well. So we picked a few again this week to answer them. Before we do that, we'll talk a little bit about the markets, right? It's been quite tumultuous, even every week now. We're kind of saying this, but it's been a lot of volatility in the markets because they're reacting to a lot of news, right? And there's a lot of news coming out, and one news is here, one news is there, markets are here, markets are there, right? Kind of thing. But what really dramatically changed things, Freddy, from last week was actually over the weekend, right?
Yes.
When the markets were
shock.
We had an oil shock. Do you want to explain a little bit what even happened? Because I think a lot of people saw the headline, but what's actually going on?
Yeah, and it's also counterintuitive at first, right? Because why would a crash in oil prices
be a bad thing for the economy?
Be a bad thing for the stock markets?
Yeah.
Now, the background. For a long time now, the Saudi Arabians have been sponsoring other countries' sort of output. What it means is that in a lot of the production cuts, so they can stabilize prices, there's a lot of cheating and among other countries like Venezuela, Nigeria. And Russia came into the group of OPEC. We call it OPEC Plus. It's when they all collectively agree, even Russia, to control production and hence put a floor to oil prices. However, geopolitics came in.
Yep.
The Russians believe that this is the opportunity to crash the US shale industry.
Yep.
And
because they feel like they're kind of like being sanctioned for everything. This is the one thing that they can control, right?
Yeah. And also they're more ready in their budget, their economies, more prepared for lower oil prices than any other ones.
Yeah.
And so when Russia disagreed with the last meeting on last Friday, to control productions, Saudi Arabia adopted an aggressive strategy to flood the market with as much oil as you can produce.
Okay.
They currently produce 9.7 million barrels per day, and they claim that they can ramp it up to 12 million barrels a day. That really spooked the markets. So we had a second biggest one-day price movement in oil contracts.
Yeah.
Second biggest ever, if I get it right. And it generated shockwaves through the world because if you think about it, there's a lot of regional banks in the US that lend money to US shale companies who's now going to be in trouble with lower prices.
There could be bankruptcies, right? Defaults on their loans.
So there's a lot of credit market contagion that the market is pricing in. And also, if you look at the S&P 500 index, there's a good amount, like 10% of the market value of the US companies being in the energy sector.
Yeah.
And you are essentially saying we are writing down the value of energy companies by half right away. And half times 10% is a 5% market drawdown. So that easily is the case that the market is pricing now.
Yep.
Yeah. The good news is we get there so quick and prices, so more bad news in energy have failed to see further reaction.
Yes.
So that's how the market functions.
Yeah.
You price it all in first, then you wouldn't react anymore. If you don't, you will still continuously react to it.
Correct.
Yeah.
Yeah, no, I think that sums it up pretty nicely. And then with on top of that, right? And this all comes at the same time, unfortunately, at the same time as the virus, right? Keeps spreading. I think we're seeing some good news out of China and Korea, but worse news coming from Europe, especially Italy, but among all the European countries actually, right? The spread is getting a lot more. Same in the US, right? So how do you see the virus keep impacting the market? Because we already saw a big drawdown, like how much is priced in, how much do you think is still room to run there? And then let's talk a little bit about how the situation is also being handled by the US government, because I think they're getting a little bit under pressure now because it doesn't seem like it's not been the best PR show over there.
Yeah, let's tackle the first thing. The moment the virus go global and it was hitting Italy really hard, is when global markets started reacting. And that time, the clock started on 19th February this year. And in our study that we have done, it looks at all past epidemics and their impacts on global stock markets. We have seen that the clock usually lasts for 2 months or less, with the exception of the HIV in 1981, where global markets impact were longer. It was about 5.1 months of impact. In all cases, they failed to bring a bear market, but they did bring short-term volatility and corrections in global stock markets. But to bring about recession is a bit of a stretch, because by the facts, before the virus has hit, we've seen Q4 consistently, leading economic indices in China and also the US rebounding very meaningfully. So all this that's going to happen is just going to delay the momentum of the recovery, but it's unlikely to derail it.
Yes, completely,
just gotta be a
right?
bit more patient.
Yeah, exactly. So then how do you then, going back to question number 2 then, right? Because obviously this is all over the news. It's always the Americans, right? Because still this is the biggest economy still in the world, right? So there's a lot of focus on how they're handling things, right? From, this is where also the volatility came a little bit in the market this week, right? Monday, Tuesday, Wednesday was because Trump says one thing, he's going to have all these cuts, payroll cut, we're going to give sick leave to people on hourly wages, right? To saying, oh, I'm going to meet you guys all for a press conference on a Tuesday night, they're not showing up.
He was reacting to the episode on Air Force One. He was on the plane and one staff had contracted the virus. So that really scares him personally. So he went from his party line of being aloof to suddenly ready to spring into action. Now, of course, getting payroll tax cuts through the Congress takes time. It doesn't work like the way Trump would say it would. So market got a bit excited, but then reality hits back where, hey, there's a Congress out there, there's procedure for this. So, but it is going to come. It is budgeted. And there's an election going on now where Joe Biden is going strong. And Trump the last thing he needs is a weakening economy and a virus outbreak that's out of control.
And especially if it looks bad on his PR side too, right? Because this is what he runs on, right? Good economy, making the American people better off than before.
So to help user a bit more, we need to put things into perspective. A lot of the bad news are out. It's not new to us now that Italy is still having 1,000 new cases a day, and maybe 15% of those new cases you see in deaths. That's exactly what China has gone through. But the thing is that, look at the numbers in China. The amount recoveries far outweigh new cases, and they're about to unfreeze a lot of the lockdowns. The lockdown is what really caused the market impact rather than the virus itself. Although personally we should be aware and be careful in taking care of ourselves in the physical world, but the market is more concerned about the shutdown than otherwise, right? So the moment, and you already seen China is detouring. Apples have reopened a majority of their stores in China.
I think there's only like 2 or 3 left.
However, the store opening times are shortened. So over time, they're going to start slowly getting back to normal times. When you see that, things are going to untour in China, and that will really offset the growing negativity now in, say, Italy, Germany, and even the US. So there's a little bit of a tug of war now between the bears and the bull, and the bears were winning the battle, but now it's becoming a more even game from here. This is a great time to be investing.
Good, very well said, Freddy. So let's move on from markets. Let's move on to some of the questions from the listeners from the previous videos. And one of them is from Andreas Toe. And he asked, hey, Freddy, if I'm just new to StashAway, right, is this actually a good time to start or not?
That's never a good time to start because the time is now. As Einstein have said, the power of compounding is the 8th wonder of the world. That means you need to stay invested. You need to let time take its effect in terms of growing, right? However, along the road, there will be bumps, ups and downs in the markets. That's the reason why we're getting rewarded in returns. So the number one thing is to start early and set your risk correctly. And at StashAway, we believe in stress testing. So all portfolios are going through a vigorous process of stress testing against scenarios like 2008 crisis, tech bubble bust of 2001. We go through the top 10 pain markets and to see whether the risk estimates are well within those numbers, are capturing the majority of all those numbers, and hence the risks are meaningfully measured. So if you've chosen X amount of risk and today's market is volatile, but it's only 1/3 of your total risk budget, which actually that's roughly where we were. You are merely sticking to your investment plans. Nothing has really changed. Downturns has been within what you have budgeted and prepared for. So really, the time is always to start now. Yesterday.
Yeah, exactly. Yesterday would be even better.
Yes.
Correct. Yeah.
But risk management also is, in principle, you should build it into portfolios on day one.
Exactly.
Not when an event or bad news came out.
Because then it's too late, right?
Yeah, so reacting to it's too late.
You want to have it.
That's right.
Exactly.
So that's what we believe in StashAway, and that's what we do for customers on day one.
Yeah.
We do not want to rely on reactive strategies.
No.
We prepare for them from day one.
Yeah, well, I think that is a very good answer to Andreas's question. We got another one from CKL. He was asking, so when we adjust risk in our portfolios, right, what's the impact of all the transaction fees of buying and selling the ETFs, right? And so in that way, should I minimize changing the portfolios as a user? And yeah, what is the impact of the fees, right?
I would put it this way. You should set goals compatible. You should set portfolio risk level compatible to your goals.
Yeah.
Retirement in 30 years or paying down payment for a flat. The less time you have, relatively less risk should be taken. And we don't advise changing this risk level often because you're supposed to stick to your goals and try to achieve them, right?
Yeah.
However, you can flexibly do it on the platform at no cost.
Exactly, and this is what I think he was asking, because I think he was confused. He thinks that we are
the fees on our platform includes the transaction cost with any changes that we bring to your portfolios. For example, when you change risk level, that doesn't cost you anything.
Correct.
Or when our algorithms picking up a change in the economy, or the severe valuation distortions, and we want to enhance the portfolio by changing allocations into different asset classes, that costs you nothing. Correct. It's called re-optimization. It's a free service on StashAway's platform, but it's also optional.
It's also optional.
Yeah.
And I think, and then the main question I think you answered, right? Having the right risk profile means you should not be changing it, because we'll be watching it. We'll keep it constant with your risk level that you chose in the beginning, right? So from that standpoint,
I would rather our algorithm change it for you.
Correct.
Because it's the best thing for us to do for you, and it costs you nothing.
Yes.
But for you to change your goals often, that is a sign of something needs to be done more carefully on the financial planning side.
Correct.
Yeah. So back to first principles.
Yeah, exactly. Yeah, very much so. Thank you, Freddy, for answering those questions from our listeners. Again, if you have any more questions, always feel free to post them in the comment box below, right? So we'll pick them up throughout the week, and then we'll answer them during the video every week. Couple events are coming up to wrap it up here. On Tuesday next week, March 17th, we're going to have a live webinar in Singapore on investing basics. So this builds up if you attended this week's Financial Planning Basics event. So they kind of build up on top of each other. So we'll talk about investing basics in Singapore. And then in Malaysia on Wednesday next week, March 18th, we're going to have a seminar, and it will be on how to plan for your retirement, where we talk about things like EPF, and how you save for your retirement in a much more streamlined way. So if you want to attend any of those, there's links below the video that you can click on to sign up. And otherwise, Freddy and myself will be with you again next week, and we're looking forward to any more questions and hopefully less volatility maybe.
Yes.
All right, have a great day.
Ciao.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.